Welcome back to AlgoBot, the channel where we take automated trading strategies apart and study how they think. I'm your host, and today we're examining an expert advisor for MetaTrader 5 called 3-point trend reversal. This strategy is a modern take on the classic 1-2-3 swing pattern, made famous by traders like Victor Sperandeo and Ross. Instead of chasing a trend that's already running, it patiently maps market structure and waits for the moment a trend appears to change direction. By the end of this video, you'll understand exactly how it reads swing pivots and how it decides when to act. So what exactly is the 3-point trend reversal expert advisor? At its core, this is a market structure strategy. Rather than relying on a smoothed oscillator or a moving average crossover, it reads the raw shape of price itself, the swing highs and swing lows that every chart is built from. It is designed as a reversal system, meaning it aims to step in at the moment a trend appears to change hands, not to ride a trend that is already mature. The engine behind it is elegantly simple. It uses fractal pivots to detect genuine swing points, and it uses the average true range, or ATR, to measure volatility so that its filters adapt to whatever market and time frame you place it on. Everything is derived from raw open, high, low, and close data on a single primary time frame, which keeps the logic transparent and easy to reason about. This approach can be applied to any symbol and time frame in MetaTrader 5, from major currency pairs to indices and metals, because ATR automatically scales its thresholds to each instrument. Traders who are drawn to price action and classical charting concepts, like the 1-2-3 pattern taught by Sperandeo and Ross, will find the logic familiar and intuitive. It is worth being clear about who this is for. This is not a high-frequency system that acts dozens of times a day. It is a patient, selective approach that may wait through many bars for a clean structural setup to appear. It rewards traders who value discipline and well-defined risk over constant action. As always, remember that this video is educational information only. It is not financial advice, and trading carries a real risk of loss. Our goal here is simply to understand how the strategy is built and how it makes its decisions. Let's break down the mechanics step by step. The strategy begins by simplifying price action into its essential skeleton. Every closed bar is examined to see whether it forms a fractal pivot. A pivot high is a bar whose high stands strictly above the highs of its neighbors on both sides, and a pivot low is the mirror image. The number of neighboring bars checked on each side is set by the pivot length parameter, which defaults to 3. These confirmed pivots are then chained together into an alternating zigzag, so the structure always reads as a high, then a low, then a high, and so on. Once at least 3 pivots are on the board, the strategy looks for the 1-2-3 signature. For a bullish setup, it wants a low as 0.1, a rally to a high as 0.2, and then a pullback to a higher low as 0.3. That higher low is the key clue, because the previous down leg has been arrested when price refuses to make a new low. The strategy then waits for a closing price back above 0.2. When that close arrives, it marks the first higher high, structure flips upward, and the approach signals along. The bearish setup is the exact mirror. 0.1 is a high, 0.2 is a low, and 0.3 is a lower high that shows buyers are losing ground. A close back below 0.2 confirms the first lower low, and the approach signals a short. Several filters keep the strategy selective. The reaction leg from 0.1 to 0.2 must span at least a configurable number of ATRs, set by MinLegAtr, so tiny wiggles are ignored. The breakout close must clear 0.2 by a decisive fraction of ATR, and the breakout bar must close in the direction of the trade, so a weak, doubtful candle does not qualify. Risk is defined structurally. On a long, the stop is placed just beyond 0.3, buffered by a fraction of ATR set by stop ATR buffer. On a short, it sits just above 0.3. The take profit is a fixed multiple of that measured risk, controlled by the risk-reward ratio, which defaults to 1.8. If the trade travels 1 full unit of risk in its favor, the stop is pulled to break even. So many trades can only scratch from there. Finally, each pattern is armed only once and then retired until a fresh pivot forms, which prevents repeated reentries on the same level. Here's the heart of the strategy as it appears in MetaEditor. At the top, we have the input parameters. Pivot length sets how many bars define a swing pivot. ATR period drives the volatility measure. MinLegAtr is the minimum size of the reaction leg. Breakout ATR fraction is how decisively price must clear point 2. Stop ATR buffer pads the stop beyond point 3. Risk-reward ratio sets the target as a multiple of risk. Max confirm bars limits how stale a pattern can be, and use break-even toggles the break-even move. Lots is the fixed order size. The first block is the bullish 1, 2, 3. It checks that point 3 is a low, point 2 is a high, and point 1 is a low. It confirms point 3 is a higher low, that the reaction leg is large enough, and then builds a fresh cross, where the previous close was at or below point 2 and the current close is above it by the breakout fraction. If that holds, and the bar closed higher than it opened, the code reads the ask price, places the stop below point 3 or the bar's low, computes the risk, sets the take profit at the reward multiple, and calls trade.buy. The second block is the exact mirror for the bearish 1, 2, 3. Point 3 is a lower high. The current close breaks below point 2 by the same fraction, and the bar closed lower than it opened. The stop goes above point 3 or the bar's high, and the code calls trade.sell with a take profit the same reward multiple below the entry. Both sides share identical, symmetric logic. Let's watch the strategy work through a full cycle on this illustrative chart. First a long, then a short. On the left, price is sliding lower. The first candle pushes down, and the second candle carves out a fresh low. That low becomes point 1 of our bullish pattern, the anchor of the whole setup. Notice we're not buying here. The strategy has no interest in catching a falling market. It simply records the pivot. From that low, buyers step in. The third candle rallies strongly, and its high forms point 2. This is the level everything now hinges on, drawn on the chart as the long point 2 level at 1.0875. The distance from point 1 up to this point 2 is the reaction leg, and because it spans more than the required 1 ATR, the strategy accepts it as meaningful rather than noise. Now comes the most important part. Instead of collapsing back to a new low, price only eases off. The fourth and fifth candles drift down and settle into a higher low, which becomes point 3. That higher low is the tell. The prior downtrend has run out of energy because sellers could not force a fresh low. The pattern is now fully formed and armed, waiting for confirmation. Confirmation arrives on the sixth candle. It closes decisively above the long point 2 level at 1.0875, and just as the rules demand, it's a strong candle that closes higher than it opened. That break marks the first higher high, structure flips upward, and the buy entry marker appears on the chart. The stop is tucked just below point 3, a tight, structural place to be wrong, and the take profit is set a fixed 1.8 times that risk away. Price follows through. The seventh and eighth candles climb, and once the move has run a full unit of risk in favor, the stop is quietly pulled up to break even, removing the original downside. The move reaches the take profit target, and the long is booked as a winning example in this illustration. Now watch the market roll over into the mirror image. The ninth candle prints the highest high of the sequence. That peak becomes point 1 of a bearish pattern. Price then pulls back, and the 10th and 11th candles dig out a low. That low forms point 2, drawn here as the short point 2 level at 1.0896. Buyers try once more, but they fail. The 12th and 13th candles bounce into a lower high, which becomes point 3. Because this high sits below point 1, it shows the rally is weakening and momentum is fading. The bearish pattern is now armed. The signal comes on the 14th candle. It closes below the short point 2 level at 1.0896 by the required fraction of ATR, and it's a down closing bar, exactly what the rules require. The sell entry marker appears on the chart. The stop is placed just above point 3, and the take profit sits 1.8 times the risk below the entry. Price obliges, sliding lower into the final candle, where it reaches the short take profit target. And remember, each pattern is armed only once. After the entry, it is retired until a brand new pivot forms, so the strategy never keeps hammering the same level. Both trades followed the same disciplined blueprint. Map the swings, wait for a higher low or a lower high, demand a decisive close through point 2, and define risk before ever taking the trade. That symmetry between the long and the short is the core idea behind this approach. And that brings us to the end of our deep dive into the 3-point trend reversal expert advisor. Today we unpacked how it maps market structure into fractal pivots, how it recognizes the classic 1-2-3 reversal pattern on both the long and short side, and how it defines its stop loss, take profit, and break-even logic with structural precision. Remember, everything we covered here is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Every strategy experiences losing trades, and no approach works in all market conditions. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss what's coming. You can find more strategy analyses over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.